Well, hello and welcome to this week's market update, and more importantly, how we've been making money and where we're going to be making money this week and beyond. So this week has quite a lot of economic announcements coming up that could move the market. CPI, inflation, that will be very interesting. It is such a flawed way of measuring the increase in the cost of living. However, that's what they continue to use. So certainly traders will be keying off this. If we see a large increase in inflation and CPI, that the market won't like that, but that'll be something that they will be keying off. I mean, we know that there's inflation, right? We know that it's not transitory. I mean, house prices have had their broadest world or global increase or boom, the biggest one in the last 20 years. And we've got food prices, according to the World Food Index, that have gone up every single month for the last 12 months. Food, you can see it in your groceries when you go shopping. We know steel has tripled. We understand corn gone up dramatically. Lumber, no doubt about that. Soybeans have gone up. Just about everything's gone up. Used cars have gone up. It's it's here, and it's probably going to get worse. So that'll be interesting to see what happens there. We've got manufacturing index, import and export prices, industrial production, petroleum status report, jobless claims, certainly be looking at that, and retail sales and consumer sentiments. There's quite a lot happening over the next 4 days that could move the market one way or another. We'll certainly wait and see what happens there. Now, if we look at the SPX, we can see right now that it is using this 50-day moving average, this purple line here. It's using the 50-day moving average as a support level. Many, many times it has actually done that, all the way going back to last year. So right now, we're getting close to that again. Are we going to bounce from the 50 and continue to move higher, or are we finally going to break and then have a consecutive closing day below the 50? Here we broke, but the very next day we're back up above that 50-day moving average. I want to close below, and then another confirmation day closing below, then we'll really start to get bearish. So keeping a close eye on the 50-day moving average on the SPX, which is the best gauge of the overall stock market. So there's some things that are going on there. What have we been doing to make money recently? Well, Lulu is a call debit spread that we had on. It's expiring in just 3 days. And what we're going to do now is take our profit. We sold the 420, bought the 400 call. We needed it to get, the aim was for it to finish above 420. Let's go and have a look and see what Lulu has done. LULU. There it is. Boom. Beautiful move to the upside. And what we're going to do now is close the trade out now. Okay. So this call debit spread, we're about to close out now for 101% return in, what's that, about 6 weeks, right? 6 weeks, 101% return. We put $873 per contract, per spread into the trade. And we're now going to close it out for $1,755 here, right? So a very nice profit of $882 per contract. Great trade. Taking that off the table right now. Huge winner. Now, another trade that we spoke to you guys about was Microsoft. We're closing that out as well. So Microsoft expires in 3 days. That's one we have already closed out. And I was mentioning this to all of you here, my subscribers in YouTube. We closed that one out for 106% return in 2 weeks. 106% return on our risk, how much money we put into the trade. So another very nice trade. And then I spoke to you guys about Apple. We're going to close out Apple right now. We needed it to get above 150. Expires in just 3 days. So if we have a look at Apple, which is right here, so we type in Apple. We can see right now in pre-market it's above 150. It closed at 149.55. We needed to get above 150. What's the value of it now? It's $3.51 or $351 a contract, right, for every spread that you buy. What's a spread, Sean? Where you sell and buy an option at the same time. What's the aim? To finish above, with a call debit spread, to finish above the sold call strike price, in this case 150. Sell, strike price 150. So we bought it for 146 when the stock was $146.09. Right now it's almost $4 higher than that. So what we're going to do is simply just close it out. That will be a 54% return in 3 weeks, or $123 of profit per contract. Some of our members have 10 and 20 contracts, so multiply that by 20. 123 by 20. Very nice, right? So close that one out now for a winner as well. Now, the other one that we were looking at now, and I did give you a bit of an idea of how you could do it last week, but let me just show it to you, right? Let me show you guys here on Facebook how I would do this. This is on Tesla. Okay, so let's look at Tesla firstly. Right now, trading at 743. Let's go back and have a look. Just a few members were asking me to look at this again, a few subscribers. Now, if you ever want me to look at anything in particular, just let me know and send an email to support@cashflow options, all one word, cashflow options with an s.com.au. Let me know what you'd like to see. Let me know if you're enjoying the content, and we can continue to do it. So, pretty bullish candle here, right? So sellers tried to drive it down, big long wick, and then buyers said, no, and they drove it all the way back to close here. So that's quite a bullish candle. It's above the 50 and the 200, sort of recently been using the 200-day moving average as a support level. Pretty good little trend line going through there as well. Looking pretty good. What I'm looking for it to do is just get above 770, which is just there, right? 770 right there. So very close to where the current price is. Wouldn't take much for Tesla to get above 770 in the next 9.5 weeks. So if I can get Tesla moving above 770 in the next 9.5 weeks, I could make a very nice return. Let me show you the way I would set this up with more detail this time. So the 19th of November is the expiry, right? About 9.5 weeks. I'm going to sell and buy a call option at the same time. Sean, why would you set it up as a spread instead of just buying the option? Well, if I bought the 740 call option by itself, it's going to cost me around $6,000, okay? Now, for some people's accounts, $6,000 is okay, right? They have a larger account, that's all right. But if that's beyond your R, your risk per trade, then, that's a bit rich for most people. So how can we get involved in Tesla for this move, right? 743 now, looking for it to get above 770 in the next 9.5 weeks for a much smaller risk. Okay, well, you use a call debit spread where you sell and buy an option at the same time. So what's the aim of the trade? To remain above or to move above 770 come expiry. When's expiry, Sean? The 19th of November. So 770 is the price level we want it to move beyond. Now, if it's very close to 770, say 772, something like that, and it doesn't really move very much, we'll have to wait all the way until the 19th of November. However, if it has a move higher, say in the next couple of days, we may be able to get out of this for almost a full profit very quickly. Okay, so you don't have to stay in all the way to the 19th of November, but if the price does move strongly, we can get out very quickly and take a nice profit. So anyway, the aim is for it to get above the sold strike price, 770. So it's going to cost $1,475 per contract to actually set this spread up. That's the cost. The maximum value, right, of the spread is the difference between the bought and the sold strike price, $770 and $740, $30. That's the maximum value of this spread at any one time. This is a fixed limited profit strategy and a fixed limited loss strategy. And the reason we do it is time decay doesn't really hurt you with this because you're selling one and you're buying one. When you're buying an option, time decay hurts you. When you're selling one, time works for you. So it's sort of cancelling each other out there. So we don't have to worry too much about time decay here. And the other thing is it makes it considerably cheaper, right? We can get in for $1,475 instead of $6,000. So that's a big difference. And obviously much, much cheaper than buying the stock at $743, buying 100 shares, right? So that's the other reason. But so the maximum value, difference between the spreads, okay, which is $30, minus what we're paying for it, $14.75 per share we're controlling. One option controls 100 shares, right? So $14.75 per share we're controlling, which would leave you with $15.25. Thereby, our maximum profit is $1,525 per contract, or 103% return on our risk. What's our risk? What we paid for it, $1,475. Now, this does have a break even. In any sort of trade you're doing, you need to understand where your break even is. Where's your cost basis? Where am I starting to lose money? And you need to know that to the cent. So we go the buy strike, 740, there it is, buy strike, 740. Add on the cost, $14.75 per share, gives us a break even for this spread of $754.75. So it must move above that price, 743 now, must get above 754.75 for us to be in a profitable position. Now, what I would probably do is set a stop here on this spread at 725, thereby risking only 750, right? 750 is the risk if we get stopped out, and our potential profit is $1,525 per contract. So that's just over a 2-to-1 risk to reward. Asymmetrical risk working in our favor. Higher profit potential than the risk that we're taking on the trade. So that's a way that I would probably set that one up. Let me know if you like that, or if you just prefer me just to say, look, I'm looking to do a trade on Tesla and I don't really talk about the details. Either way, I don't mind. But let me know. Otherwise, how else will I know unless you send me an email to support@cashflowoptions.com.au. All right, so that's the way I would do that. The other trade that I'm looking at is APPS, Digital Turbine. Digital Turbine has had a considerable move down from around $102.56 to be exact. It's had a considerable move down from there, right? Right now, trading at 62.15. It came down and bounced off this significant support level here, as you can see, around $48. Yeah, around $48. Bounced off there. It's now moved above the 50-day moving average. Now, this will be a long-term position, okay? I'm not looking to do a short-term trade on this, long-term trade. And, you know, it's right in between the 50 and the 200-day moving average. So normally stocks don't like to live in between the two. It'll either get above both or below both, right? So it's going to break out here somewhere. And for me, after such a considerable move down, I believe this stock is really good value now. So what I'd like to do is set up a collar trade on this, where I can bring in income, reduce my cost basis, and build downside protection into the trade, and have a very conservative trade, making around 5% for the month. So, Digital Turbine, a couple of things about the company. They used to just have one source of revenue, right? Their app discovery service. Now, obviously, having one source of income, whether it's yourself, just your job, one source of income, you're only one step away from poverty, okay? You've got to have multiple sources of income, and same with the business, right? So you can see now they've got content discovery, brand advertising demand, and these are the different products, right? And you can see Ad Colony, Appreciate, and you can start to see that they've built now, they've turned the company around actually, and really built multiple income streams. This one here, Single Tap, is very good. We'll talk about that in a second. Now, are people, installing and using their software on their devices? Well, absolutely. Look at the growth here. Just incredible. Almost 600 million devices now in the third quarter of 2021. So they're certainly growing, no doubt about that. But this Single Tap app install is very, very good, right? Normally with an app, you've got to click on it, you've got to download it. There's a whole range of different steps and processes you have to do before it's on your mobile phone. But with this Single Tap install technology, Digital Turbine, you simply click on the app and it installs it straight onto your phone. So this is obviously very advantageous to get apps on your phone very quickly. A lot of people are using it. Obviously, people that develop these apps and companies want to use this, because you're going to get more apps on people's devices with a single tap and make it easier for people. Increases the amount of revenue, amount of advertising, a whole range of things. And this is good news for Digital Turbine. Are they growing their revenue? Yeah, they are, and they're growing their profits at the same time. So a lot of people could make good money, but it's not a very profitable business. This is actually profitable, and they're growing their revenues as well, so that is a good thing. The only downside with APPS, let me just show you a little bit more here. The only major downside with APPS is the fact that this one-tap app install, which is fantastic, it sort of bypasses Google a little bit, right? So Google could get upset with that and cause some problems, but so far so good. And I think with the price where it is right now, 62.15, there's a good support level through there as well that it's bounced off, like I showed you before. Most analysts have a target on this of around 100, some 90, but around $90 to $100. Right now, sitting at 62. I think it's very undervalued. Okay, so if we look here at Yahoo Finance and I type in APPS, and we have a bit of a look at the fundamentals of this because we're going to hold it a little bit longer term. We come over here, click on statistics. Okay, let's just have a bit of a look at this. I mean, look at the PEG ratio, 0.81. Very good, right? Anything under 1 shows the company is undervalued, okay? And we'll talk a little bit more about that in a second. Return on equity, 19.22%. That's solid, right? The owners of the company are generating a return for their investment in the company. Shows the company is well managed. Look at the quarterly revenue growth year over year, 260.3%. Quarterly earnings growth, 43.7%. So that's very solid as well. The only major issue with this company is the fact that it does have a lot more debt than cash. Normally, I like the debt to, be twice as much as the overall debt, ideally. But the growth prospects for this company, where it is right now, do make it attractive. But that's the only issue. So far, they've been able to handle that, have no problem servicing their debt, but something to keep an eye on. The amount of institutional ownership, over 30% that I look for, 65%, which is fantastic. Some insiders own the company as well, so that's good. If we have a quick click when we over here with analysis, they're growing their earnings per share compared next year compared to the following year. Always forward looking. The market's forward looking. You should be forward looking as well. They're certainly growing their earnings per share as well. Sales growth has been very good, and their earnings surprise, right, have been positive for the last 4 quarters. So that means their actual earnings were higher than what the analysts had anticipated for the last 4 quarters straight. So that's nice. And looking forward, are they going to continue to be able to grow? Their growth estimates for the company next 5 years, 50% per annum. Very solid. So the growth estimates are very good, right? Very good growth estimates for this company, and that's what you want. Be growing your earnings, growing your profitability. And then the PEG ratio brings us to a concept called GARP, G-A-R-P, growth at a reasonable price. So when you're getting a stock with a PEG ratio, price earnings growth ratio is what that stands for, below 1, that shows you do have GARP, growth at a reasonable price, and it is undervalued at this price of $62.15. Again, long-term trade, okay, a long-term trade on this, and I do like the look of it for those reasons. Now, obviously at some point it's going to have earnings. We'll just see when that is. They may not have told us yet. Haven't confirmed it yet with the company, otherwise there'd be a tick there if they confirmed it with the company. But right now it's looking around the 8th of November. Could be a few days either side of that. So not having to worry too much about it right now. So what we could do is we could set something up like this, where we buy the stock for $62.15. Okay, we sell the 60 strike in the money call, being very defensive and in the money call for $5.60, and then buy the 50 put option. That's a collar trade where we buy 100 shares or multiples of 100 shares, and then we sell a call option and buy a put option. That's what a collar trade is. Very defensive, very conservative type trading, right? Not like our 100 and 109% returns we've had with our call debit spreads. It's more conservative, longer term trading, sort of like for a retirement account, for example, right? So that's probably how I'd set it up. Now, I'd set the 50 put option just for the 24th of the 9th expiry, just 10 days from now, because I don't want to get into the trade and all of a sudden it has a massive fall. I want to have some insurance there. So this put option, if it drops below $50, the stock has a big fall and drops below $50, that put option will go up in value. That will offset the loss. We'll be able to sell that put option for a very nice profit if that happens. So what's the cost basis? $62.15, what we bought the stock for, minus $5.60, okay, which is our call premium we got for selling the option day one, $56.55. Then we have to add the cost of the short-term insurance in, $15 a contract, brings us to $56.70. What does that mean, Sean? That means, in essence, you're buying Digital Turbine, APPS, for $56.70. So $5.60, which is what we're getting in call premium, divide what we paid for it, $62.15, 9%. So Digital Turbine, APPS, needs to fall 9% for us to lose any money. So we've built downside protection into the trade. In addition to that, we've also bought a cheap insurance policy if the stock does crash for whatever reason and fall below 50. So we're really covering ourselves here. Very defensive type trade. So if it remains above 60 come the 15th of the 10th, the expiry for where we're selling the call option, because what are we doing here, Sean? Well, when you're selling a call option against 100 shares that you own, or multiples of 100 shares, then what you're saying is I'm happy to sell my stock at this price, 60. Sean, why would you want to do that if it's 62.15? Well, hang on. Remember, our break even is 56.70. We're only paying $56.70 for these shares. And we're agreeing to sell them at a higher price, 60. I understand. I get you, right? So if we can make $3.30 per share or $330 on 100 shares, divide that by what we're paying for it, 62.15, that's a 5.3% return for the month. In a very conservative strategy with a lot of downside protection and risk management built into the trade. Now, there's a whole range of things we can do to manage this trade. And what I might do is each week, I might go through how I'm managing this if you want to. Let me know if that's something you want me to do, or just move on to another trade, right? It doesn't really bother me either way. But if you like this process and how I'm doing it, and you want to see how this whole thing unfolds, let me know. Send an email to support@cashflowoptions, all one word, options with an s.com.au, and I will do that. Now, if it finishes below 60, where we're agreeing to sell it, then what will happen is you'll keep the $560 income for selling the call option. You'll keep the 100 shares, and you'll sell another call option against it next month. Okay. Now, this isn't a strategy that we use all the time, but it can be a very effective strategy, provided you understand what you're doing. Okay, so that's just another example of a trade that we are getting into as well. So let me know if you found that useful. Okay, now if you use interactive brokers, I could even go through and show you how I would set the trade up. There it is there, right? So there's the buy right there where we bought 100 shares, selling the 60 strike call, and we've got the 50 strike put option in there as protection. There's the actual trade right there. So let me know if that's useful, and if you wanted me to go through the process of placing it at interactive brokers, maybe that's not something you need. I don't know, right? But anyway, that's how that works. I hope you found that useful. I hope you found that enjoyable, and that, my friends, is the complete process. So thank you so much for listening. I appreciate you being here. Please send me your feedback, and to that email I mentioned, support@cashflowoptions.com.au, and we will continue to give you the information and content that you want. All right, my friends, really appreciate you listening. Talk to you again next week. My name's Sean Allison. All the best, and bye for now.